All right, guys, welcome back for another video. In today's video, I want to talk about the U.S. equities market, the Federal Reserve, quantitative tightening, and tie it all back into Bitcoin. It'll just be a broad overview of the state of the market. If you guys are on social media, if you follow the market at all, I'm sure you're aware of what the Fed's actions have been recently, what they've been saying, what they've been doing, raising the federal funds rate, and then the quantitative tightening program, as it's called, letting bonds mature off the balance sheet. So if you're on social media, you probably have, seen different opinions and consensus. And I don't want to use the word narrative, but there definitely is a consensus in the market that quantitative tightening is bearish, is going to lead to a sustained downtrend. And I think one of the reasons why that is because people understand what quantitative easing is, and they understand how bullish quantitative easing is, and then they assume that quantitative tightening is the direct opposite of quantitative easing, and it makes sense with the way it's the way the wording is structured. That would make sense, but it's a simplification, and hopefully I can provide a little bit of nuance there and prove that it's not the opposite of quantitative easing. A good example of that is that in quantitative easing, the Fed steps in and buys bonds, and so essentially what they do in that situation is they buy bonds. They're the bidder of last resort, and they will buy bonds at any price. So that's a buyer entering the market with a level of conviction that is much higher than anything really you could have otherwise. And a good example of that is if you had the old example of a lemonade stand. If somebody's kid is having a lemonade stand and they walk by and offer to buy lemonade, well, they're going to buy that lemonade off that kid for a ridiculously high price, right? Because it's their kid and they're just going to buy it no matter what the cost is. And, they'll sell them for $10, $20. They don't care. It's a similar concept. Um, and quantitative tightening is different, right? They're not, people use the word like aggressively selling or aggressively reducing the balance sheet. The Fed is not aggressively reducing their balance sheet. What they're doing, and they're not even selling bonds. They're not only are they not aggressively selling, they're not selling. They're letting the bonds mature. And so ultimately, what that does is because you have the Fed taking up a larger and larger share of the demand of the Treasury market, and this is a very important stat. Look at the percentage of uh, treasuries held by private investors. You want to look at the percentage held by private investors, as well as the percentage held by private foreign investors or foreign investors generally. Um, Ultimately, what's happening is the Federal Reserve became a larger and larger buyer and purchaser of the overall market share of bonds. So when they do something that creates demand destruction, like stopping buying bonds, letting the maturities roll off, that creates a major demand, uh, black hole of demand, right? Demand is just drying up. And as a result, the bond market is getting crushed, right? So you see bonds selling off. Capital is flowing into the reserve repo market on the Fed. Uh, that's another rabbit hole of itself. If you go study the Federal Reserve, reverse repo market, essentially what that is a short, large investment banks park their capital at the Federal Reserve for a very, very short term loan at a basis point or a rate of return that reflects the federal funds rate. And that rate then represents the yield floor. So any product or investment service offering a yield lower than that yield floor is not going to be. It's just going to also have demand destruction because the what the reverse repo market is offering is a yield that is uh, has no counterparty risk, right? So in order for people to embrace counterparty risk of not parking their capital at the Fed, you need to exceed that yield that's being offered from the federal funds rate. So that's an interesting concept, right? That ties into the interest rate component of the quantitative tightening. So as you see the federal funds rate increase, you'll see the you'll see that yield-seeking behavior increase as well, because that essentially sets the floor in the the yield floor. This chart is a good example of you know how interest rates affect Bitcoin. So ultimately, you see the federal funds rate and then rise from zero, and then Bitcoin takes off from the lows and enters a parabolic rally. I've shared this chart before. The purpose of this chart is not to imply that Bitcoin is going to go parabolic. That's not my point. My point is to challenge the narrative that the rise in the federal funds rate inherently means that Bitcoin is going to like engage in some sustained downtrend. I mean, this chart itself is very contradictory to that idea, right? You see it rise from zero, and and through this rise, it encounters all phases of the market, right? It goes from zero to roughly 2.5, and it enters a bull going into parabolic, and then the blow off top, and then the sustained bear market. So it goes through all phases of the market here. So the idea that the raise in federal funds rate necessitates one type of market behavior is just, at least in Bitcoin, it's just not accurate. Now that the creator of this chart implied that it would have that effect, and that's yet to be seen. Again, I'm not using this to try to justify one conclusion over the other, but another interesting concept I want to draw your attention to is the the idea that people refer to what's been going on in the markets recently as a deleveraging event, right? You hear about that term a lot, right? Like the markets are over leveraged due to the fiat system. So essentially, that this is a deleveraging event as price goes down. But interestingly, what you see like a day ago, early June, uh, Ethereum, or excuse me, Bitcoin long liquidations hit a yearly high. Um, so Bitcoin exchange long liquidations across all exchanges, hitting that yearly high at the bottom. So that the point of this is that in order for those liquidations to be that high, this far out in the downtrend, means that leverage is still very, very present in the system. Um, and it's just contrary to that narrative that leverage has been wiped out. It's just not what we're seeing in the data. Uh, Here's another good example. You got Ethereum short liquidation. So a day ago, so previously we showed Bitcoin long liquidations, but here you've got the Ethereum short liquidations, and it's just like who is shorting down here with that size and that leverage. It just it again another thing that does not add up with the narrative. This is another thing I want to bring your attention to, and this is the Bitcoin illiquid supply divergence. This is something that I talked about previously. Um, you know, Essentially, I was talking about it before Bitcoin had in the whole Luna fiasco and the whole capitulation event, but it's still relevant. And I think one thing worth mentioning is that whenever you mention something fundamental and then price doesn't necessarily follow uh, that 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 whatever that fundamental indicator is, um, people tend to discard it, right? And they tend to go the other direction. But it's still relevant, and I think that's a mistake and an error. So essentially, what a liquid supply is showing you is that Bitcoin is, the amount of the supply in the market that is hasn't moved or hasn't shown any intention to sell is hitting all-time highs. I believe it passed 65%, which is a record. And what's important here about this chart is the divergence between the liquid supply and the price. So, you know, in previous bear markets, you just didn't see this divergence, right? Maybe briefly, for brief periods, but for like a sustained down market, you just don't see that, right? This is a very important divergence, and it's an indication that it challenges the narrative that this is going to be a sustained bear market. Um, and another so essentially what the illiquid supply is doing is reinforcing the nature of Bitcoin's scarcity and creating the environment where you could get a supply shock and a very significant short squeeze. And it's important because the conditions are such in the market that that the short squeeze, there's never been a more ripe condition for a short squeeze, and it's hitting extremes. So the corollary of that is that whatever short squeeze we see, um, if we see a short squeeze, could potentially be the largest short squeeze Bitcoin has ever seen, because it has more liquid supply and also more of the exchange balance is being taken off exchanges. So here's a good example of the Bitcoin exchange balance. Again, this is, balances on exchanges have just been in a very, very prolonged downturn, and that adds to the scarcity, right? Because there's less. Essentially, what coins on exchanges represents is sellers, right? These large players, they don't leave their coins on the exchanges if they're if they're not planning to sell. So they move it to cold storage. Again, if coins are in cold storage and not on exchanges, those that reduces the sell pressure. You have less and ultimately what you have is less Bitcoin available to cover short positions. So you could have a situation with these illiquid supply and the exchanges flowing Bitcoin flowing off exchanges where you there's not enough supply on the market to cover all the open short positions. And that's really that's the most important thing. And that's the reason why it would contribute to a short squeeze, that there's just not enough supply to cover the existing short positions, especially in an environment where everybody's short, right? Like right now where there's a consensus. Here's a just briefly want to talk about this. This is a good graph talking about retail sentiment. So essentially, retail holdings of the equities is at multi-year low. It's just a good sentiment indicator. Again, nothing major, but it does show you that where the sentiment is currently in the market. Here's another good indicator, a sentiment indicator. So this is a number of news articles mentioning a bear market rally. So you can see here, this guy, credit to this guy, he graphed the number of bear market mentions in the media and mapped it onto price. And essentially here you can see how, people's perception and their fear of the market is warped in these areas, right? I mean, their perception of what is possible in the market is just totally skewed in a direction that doesn't align with what ends up ultimately happening. And that's because of, they're reading these media articles, and that's intentional, right? The media is targeting their fear because of price action that has occurred previously. And this is an important concept to bring up, is how this conflicts with trend trading. So when people are in these fearful states, they will use trend identification to justify um, their inability to perceive the realities that exist. And if you have just had a capitulation event, of course you're going to have some type of bearish trend, right? Anytime price extends, 60%, 63%, you're going to have a some type of downtrending behavior. But where that conflicts with recency bias is another story entirely. And essentially, recency bias is the assumption that, what has happened previously will continue to happen. And that kind of fosters the fear, and, it encourages that type of limitation of perception. Now, we can go back to the price chart on Bitcoin. Just talk about that real briefly. I do want to talk about the trend trading and how trend trading has ultimately, not really been that effective, especially for people who have been trading the last 2 years or so. So, and I'll show you how it kind of impacts the ultimately the overall perception in the market. So right here, right, you have trend traders getting extremely bullish, and really people aren't bullish um, here because of the trend necessarily. They're bullish because of the parabolic rise, and perceiving this as strength. And really, that's the entirely wrong way to think about it. You want to look at parabolic rises and think of that as weakness, because the odds of price retracing into the parabolic is essentially for almost 100%. I mean, there's never been a parabolic in history that doesn't retrace, at least a little bit. Of course, not a full retrace, but um, and so of course you see this type of behavior right here. Trend trading, so the important thing here is that you note the distinction where this trend gets violated, right? Um, but the thing is, what a lot of people, the market doesn't never notices that, right? I mean, they're at this point when this price behavior is happening, they're still looking down here and saying this is the most bullish thing ever. When really, traders are looking at this and saying, okay, market structure is broken, coming off a parabola. This is like the worst time to be long you could possibly pick. Um, and uh, I was bearish there. I caught this trade very well, caught it much better than I did at the 60K high. But the idea is that, you know, these trend traders, right? So that now you have a downtrend here, and you think, okay, well, price is not gonna. We're in a downtrend. Price isn't gonna violate these highs. Comes up, violates these highs. All the trend traders get taken out, and then people are okay. Now we're gonna go up. Price comes down, violates the lows. Now it's like, okay, now we're in a downtrend again. Uh, price is gonna go. Price is gonna go down. It goes up. And then you do have a little bit of a sustained trend there. But, of course, then what people are thinking at that phase is that right here, everybody's looking at this as the lower high on the weekly. And they're thinking, okay, well, the weekly is in a downtrend, right? You've got this lower high, right, with these closes, a clear confirmed lower high relative to this area. And so people are thinking, oh, this is the downtrend. So trend traders get wrecked again. And now price trades above here, closes above there, and now people are saying, okay, well, now the weekly's in an uptrend, so I'm gonna, long here because this low is in an uptrend. Well, they get, trend traders get wrecked again, and it goes on and on and on. But same deal right here, right? You get a break above, right? Everybody, you know, says, okay, well, this downtrend is broken, right? You clearly have a change in trend here, right? Higher highs, higher lows, and of course that retraces as well. So the point here is not to, dismiss trend traders, but it's just to highlight the importance of the things that are currently happening in the market on the right side of the chart, as opposed to, relying on recency bias to confirm some of the behaviors that have, affected price on the left side of the chart, and understanding that distinction between historical and recent price action. Anyway, guys, I hope you like this video. If you like this type of content, please just make sure to like the video, subscribe to the channel, and I'll catch you guys in the next upload.